The most dangerous signals in the financial world are never loud. They do not appear as breaking news alerts or frantic headlines. They appear as silence. 3 weeks ago, buried in a dense regulatory filing released on a Friday afternoon, the classic time slot for news intended to die unnoticed a shift occurred that should have frozen every trading floor on Wall Street. Goldman Sachs, an institution that has survived every market calamity of the modern era, not by luck, but by ruthless foresight, quietly revealed a massive liquidation. They didn't just trim their portfolio. They systematically executed an exit from the one asset class that every textbook, professor, and central banker calls risk-free. They sold United States Treasury bonds. And they didn't do it alone. Over the last 18 months, the titans of the banking world have collectively dumped over $847 billion in US government debt. To visualize the scale of that number, it exceeds the entire GDP of Switzerland. It is enough capital to buy the world's largest tech giants several times over. When the smart money runs from the foundation of the global financial system while telling the public that the economy is resilient, a paradox emerges. What do they see in the proprietary data that the average investor does not? They are not rebalancing. They are preparing for a specific type of collapse. To understand the gravity of this move, we must first strip away the jargon and look at the mechanics of the trap. A treasury bond is simply a loan to the government. You lend them cash. They promise to pay you back with interest. For decades, this was the bedrock of stability. But there is a mathematical law that governs this relationship. When interest rates rise, the value of existing bonds crashes. It is not a theory, it is gravity. If you hold a bond paying 2% and the government issues new ones paying 4%, your bond is suddenly toxic. No one wants it unless you sell it at a massive loss. This mechanism is exactly what obliterated Silicon Valley Bank in a matter of 48 hours. They held billions in safe government debt. When rates spiked, the value of that debt evaporated. They were insolvent before they even opened their doors on Monday morning. That was a mid-sized bank. Now, zoom out. The largest institutions in the world are looking at their own balance sheets and seeing the same cracks forming, but on a scale that dwarfs a single bank failure. Goldman Sachs slashed their government securities holdings by nearly half in a single year. This is a liquidation event. The banks will issue press releases citing capital efficiency or Basel III compliance. These are polite euphemisms. In the world of high finance, you do not voluntarily realize billions in losses unless you believe holding the asset is a suicide pact. Goldman Sachs is hoarding cash. They are cutting exposure to commercial real estate. They are tightening lending standards. These are defensive fortifications. In a booming economy, banks lend aggressively and leverage up. In a pre-crisis environment, they retreat to the castle and pull up the drawbridge. But why now? What is the catalyst? The answer lies in the paralysis of the United States government. We are currently staring down a national debt of over $36 trillion. The interest payments alone on that debt have crossed the $1 trillion mark annually. The government now spends more on servicing its past mistakes than it does on defense, Medicaid, or children's education. This creates a doom loop. To pay the interest, the government must borrow more. To borrow more, they must issue more bonds. But as they flood the market with new bonds, the value of those bonds drops, forcing interest rates even higher to attract buyers. It is a death spiral, and the usual buyers are leaving the room. Foreign nations, historically the voracious consumers of American debt, are selling. China and Japan have reduced their holdings significantly. When the world stops buying your debt, you have only two options. Option 1, the Federal Reserve prints money to buy the debt themselves, which ignites inflation. Option 2, you let interest rates soar to attract buyers, which bankrupts the government and collapses the economy. There is no third door. This brings us to the terrifying historical parallel that Goldman's analysts are undoubtedly studying, 1979. Inflation was rampant, and Paul Volcker, the Fed chairman, raised interest rates to 20% to kill it. It worked, but it caused a brutal recession. However, there is a critical difference between then and now. In 1979, the US debt to GDP ratio was roughly 30%. Today, it is over 120%. We cannot pull a Volcker. If rates went to 20% today, the interest payments would consume the entire federal budget. The government would cease to function. The tool used to save the dollar in the past is now broken. This is the trap. The Federal Reserve cannot raise rates high enough to kill inflation without causing a sovereign default, and they cannot lower rates without letting inflation burn down the currency. Goldman Sachs knows that in this scenario, bonds are not a safe haven. They are ground zero. If the government prints money to survive, bondholders are paid back in worthless currency. If the government defaults, bondholders get nothing. It is a lose-lose proposition. We are currently in stage 1 of this unraveling, the silent exit. The insiders are distributing their risk to the outsiders. Stage 2 begins when confidence fractures. It could be a failed bond auction, a geopolitical shock, or another bank failure. Once confidence breaks, we enter stage 3, the cascade. Bond prices freefall, yields spike, and the cost of everything from mortgages to corporate loans explodes overnight. This is not a slow bleed. It is a heart attack. Remember, Silicon Valley Bank went from healthy to dead in 2 days. Systemic confidence works the same way. It is binary. It is there until it isn't. The implications for the individual are severe. This is not just about Wall Street balance sheets. This is about the purchasing power of your labor and the safety of your retirement. Pension funds and 401ks are stuffed with these bonds. If the bond market collapses, the safe portion of your portfolio could face losses of 30 to 50%. Mortgage rates pegged to these yields could screen past 10 or 12%, freezing the housing market and trapping homeowners. Furthermore, if the government chooses the path of inflation to inflate away the debt, which is historically the path of least resistance, we are looking at a permanent degradation of the standard of living. Expenses double, wages stagnate, and savings are incinerated by the invisible tax of currency devaluation. This is the reality of a debt trap. It transfers wealth from the prudent saver to the indebted state. So, why is the smart money moving now, in early 2026? Because the exits are still open. Liquidity is still available. You can still sell a treasury bond today and get cash. In a full-blown crisis, that liquidity dries up. Capital controls, withdrawal limits, and frozen markets become the norm. Goldman Sachs is not waiting for the fire alarm to ring. They're leaving while the theater is still dark and the movie's still playing. The strategy for the individual in this environment mirrors the strategy of the giant, defensive positioning. This means reducing exposure to long-duration government debt. It means holding liquid cash despite inflation to buy distressed assets when the crash comes. It means owning hard assets, things that cannot be printed by a central bank, like gold, silver, or productive land. And it means eliminating variable rate debt that could suffocate you if rates spike. The $847 billion signal has been fired. The institutions with the deepest data sets and the most to lose have made their decision. They're betting against the stability of the US Treasury market. You can choose to believe the official narrative that a soft landing is secured, or you can look at the actions of those who have survived every financial winter for the last century. The window to prepare is closing. The silence before the storm is ending. The only question remaining is whether you will be watching the collapse from the inside of the trap or from the safety of the exit.